This is Chapter 3, Cost, Value, and Profit Analysis, Part 1. So this chapter starts out with talking about the features of what cost, value, and profit is, and helping figure out what a break-even point is, and then what output level is needed to achieve a target operating income. Then in the next presentation, we'll talk about how taxes affect CVP and this formula, how managers use it to make decisions, some sensitivity analysis, how to use it to plan for variable and fixed costs, multiple products, and then applying it to service and nonprofit organizations, and then finally distinguishing contribution margin from gross margin, which would have been handy for you to have a long time ago. But the pieces where you want to focus are producing multiple products. This piece here, it's a heck of a color. And then on the other one, of course, break even and taxes. Those are the three big computational areas that you'll want to pay extra attention to. And all the problems are in the next page, so I might have you do some of those in between listening to the lectures on the chapter. Okay, so of course CVP is an abbreviation for cost, value, and profit. This is an analysis tool that managers use to understand how profits will change as units sold, variable cost, fixed cost, selling price, or some combination of these change. And it's about the relationship among these elements. And they make a statement here that managers like to use what-if analysis to determine possible outcomes. When I worked, I did that all the time. Your book likes a lot of 5-step decision-making processes, okay? So, whatever. Identify the problem, get information, make predictions, make decisions by choosing alternatives, implement, evaluate, and learn, okay? The last one is probably the most important part of it. Now, to conduct a CVP analysis, we need to correctly distinguish fixed from variable cost. Oops. Oh dear. Recognizing that whether a cost is variable or fixed depends on the time period within which the decision is made and also on the cost object. Additional assumptions followed by a CVP analysis are explored in this slide and the next. So we're saying that changes in production or sales volume are the sole cause for cost and revenue, okay? And that's not the case. You could have changes in the economy. There are all kinds of things that can affect these costs. And that the total cost consists of fixed and variable costs. In other words, not curvilinear costs. Revenue and costs behave and can be graphed and is a linear function in a straight line. And that all these costs are known and constant. And we're saying these are assumptions, but you can think of them as sort of limitations, all right? They're just things that you have to keep in mind if you're doing these analyses. And finally, in many cases, only a single product will be analyzed. If multiple products are studied, the relative sales proportions, you've got to know what they are, and then you hold them constant. And probably one of the biggest limitations here, depending on what the rate of interest is, the cost of funds, is that the time value of money or interest is ignored. So if the time period is really long, the time value of money can be increasingly important. Now here are some of these equations that express the relationships, and to make good decisions on CVP, we need to understand these relationships. And it's one thing to think that you know it, but you don't know it till you really, really can reproduce all of it and it's solidly in your head. So the contribution margin can also be obtained by multiplying the contribution margin per unit times the unit sold. And contribution margin per unit can be obtained by taking the contribution margin divided by the number of units sold. Okay, and you could take the contribution margin per unit and divide that by the selling price and get the contribution margin percentage. All kinds of different ways to rearrange this. The one that I like the best that is not right here, but maybe it's someplace else, is that at break even, maybe it is later, the contribution margin equals fixed cost. Okay? Just keep that in the back of your head. It's a handy one at different times. And the other thing that I want you to think about is this in this chart. And whenever I do break-even problems, I arrange everything in a chart like this. Okay, I literally have 3 columns. If I've got 2 pieces of information, I'll arrange it like this. So I've got my totals in the first column, and then my per unit cost, and then a percentage. Okay, and this are just some assumptions, but pretend we had 200 units that were sold here, and I put an outline of a contribution format income statement here with sales less variable costs as a contribution margin, less fixed costs as operating income. Now the other thing is these, what's significant about the percentages is that this relationship right here through these 3 columns holds steady with any changes. And that's what lets us do this analysis. I don't want you to ever use this area right here. Just put it right out of your head. You do not want to think about fixed cost per unit, okay, or as a percentage or anything else, okay? And the other thing to let it sink in is that sales, this sounds so dumb, but are cost plus profit, okay? And the variable cost is cost, and the contribution margin is profit. So you're just taking sales apart between variable costs and contribution margin, which is a contribution to cover your fixed costs. Okay? Now the basic formulas that we're going to use, and this is the one that I like so much at break even, the contribution margin equals fixed cost, but we've got fixed costs divided by the contribution margin per unit. Okay, gives us units. Fixed cost, it's a picture, divided by the contribution margin per unit gives us break-even units. And just think about those fixed costs. If I can divide that by all my little contribution margins, how many little contribution margins do I have to have in here before I break even? Okay, how many unit contribution margins? And then another one with, that's used all the time is the fixed costs divided by the contribution margin ratio will give us break-even sales dollars. Okay, so in this case, our contribution margin percentage is 60%. I'm dividing my fixed costs by 60% and getting sales of $5,000. So when I sell $5,000 worth of sales, I'll break even. It can't possibly be right. Sure, it's right. Because if I had sales of $5,000 and 40% was variable cost, that would be $2,000. It would give me a contribution margin of $3,000. Right, it's equal to fixed cost. Another way to think about this is total cost is equal to fixed cost plus variable cost per unit times the number of units. And at break even, okay, revenue minus fixed cost minus variable cost equals 0. Okay, but I'd strongly encourage you to use this as a foundation for your problems. It just helps because it lays everything out there. You can fill in missing information because of these percentages. It tells you a lot. Now, looking at one of the basic formulas from the slide before last, we can calculate contribution margin by subtracting variable costs from revenue, right? We know this. Here are several equation and contribution margin methods. So if we dissect the basic equation, it helps to emphasize the relationships between the elements, and that understanding of the relationship will provide a greater understanding of the concept that follows, such as break-even. We can look at these relationships in three different ways. Okay, the equation method, contribution margin method are two of the three methods, and you'll see them on this slide, and then we'll discuss the graph method a little bit later. And just a word of caution, if you decide maybe that you like the equation method the best and you really don't want to memorize those formulas, just be aware that the multiple choice questions especially can make it so that you have to know the formula to answer the question because of the way the data is given. Okay, so you need to know both methods pretty thoroughly. So here's the equation method, just revenue minus variable minus fixed operating income. Okay, contribution method is really straightforward with selling price times quantity minus variable cost times quantity minus fixed costs equals operating income. Okay, you can take a look at these yourself. Selling price times, that's your revenue. Here is what your variable costs are. Contribution margin is revenue minus variable cost. And operating income is the contribution margin minus fixed costs. Okay, some of them you have to think about a little bit. All right, here's one of the try-it problems. This is Tiny's Cabinets, and they sell cabinets for $600 each. Variable cost is $300, fixed costs are $20. If Tiny sells 100 cabinets, what's the operating income? Okay, now the fast way to do this, let's put a formula in here. The fastest way to do this is to look at your contribution margin. So if the selling price is 600 and the variable cost is 350, okay, then my contribution margin is 250. Okay, if I multiply that times 100 cabinets, it equals 25000, $25,000. Okay, then 25,000 minus the fixed costs. Open this up a little bit. 25,000 minus fixed costs of 20,000 gives us operating income of 5. Okay, but see how nice that is to just use the contribution margin to figure out the what your revenue would be. It won't underline for me. Oh well. Okay. And here's our 5,000. Instead, here they've got selling price times the quantity and the variable cost times the quantity gives your contribution margin. See how much easier it is to just take the contribution margin and multiply it times your quantity. Okay? And at break even, it's the quantity of output sold in which total revenue equals total cost. All right, so we can solve to get it. Let's see. Okay. This is how they did it. The way I would do it is right down here. Like you can take what you're doing here is you're setting everything equal to 0. So your selling price times the quantity minus variable cost times the quantity minus your fixed cost is equal to 0. And I'm going to say that's at break even, right? At break even. So 250 Q equals 20,000 and your quantity is 80. So when Tiny Cabinet sells 80 cabinets, then operating income would be 0. Okay, the contribution margin would be 20,000 and the fixed costs are 20,000, so there would be nothing left. Another way to find it though is just take your break-even units divided by the contribution margin per unit, or no, fixed costs divided by the contribution margin per unit. All right, so that would be our fixed costs were 20,000, right? Let's put another quick text box in here. Fixed costs are 20,000 equals 20,000. No. We'll just say 20,000 divided by our contribution margin per unit, which was $2.50. 20 divided by 250, that gives us 80. Okay? See how nice and clean that is? I'm going to slide this up. Okay. All right. We're almost there. Here's another page. Couldn't resist this. These are also break-even point examples. Oh, that's what we did. Okay. So there's your there's your contribution margin per unit. This contribution margin ratio is 0.4167. All right. Which we've got some rounding problems here. Here are the 80 units that we just solved for, the 20,000 divided by 250. But in revenues, if you took your fixed costs and divided by the 41.67%, that's the contribution margin ratio, we would get 47,996 with a little bit of rounding, so it's about $48,000 worth of sales. Okay? All right, we're almost there. And then target income is a nice thing. The break-even formula can be modified to become a profit planning tool by just adding the target operating income to your fixed costs. So here we see that if Tiny wants to make $30,000 of operating income, he needs to sell 200 units. Okay, so that's great information. That's really good. So what we're doing is taking our operating income and just adding it here to the fixed cost. All right, just think about it as another lump to cover. So the quantity would be 200. And here's the chart that I like. So fixed cost plus target divided by your contribution margin per unit. Okay, in this case we got a target profit of 40,000. And if we divide it by the contribution margin ratio, then that would give us sales dollars, right? Okay, and finally we'll take a look at a graph. This is, we call them 3 different related ways or methods to think about the model CVP relationship. And the graph method helps managers visualize the relationship between units sold, which is here, and operating income is on the y-axis. Okay, and we can look over a wide range of quantities. All right, the cool part is out here. This is all operating income. Okay, anything less than this would be a loss. And this is so this tells us right here that break even. Don't forget that the y-axis is operating income, so you could have a loss if you don't cover your fixed costs. You're going to be in a loss area here. So this chart has like a 0 about a third of the way up. Here we're at 0, and that is how much? $3,000 in fixed cost is right there. That's what that is. Oh wait, this is not the same example. This is for GMAT success. Okay. So a present value graph shows how changes in the quantity of units sold affect operating income. And this exhibit is the PV graph, or GMAT success, where fixed costs are 2,000. Okay, that makes more sense because, yeah, it's 2,000. The selling price is 200 and variable cost is 120. So every time we have another test, we make another $120. I don't know where they get 120 for the GMAT. Of course, the price is coming down now, I think, because people aren't taking it. Okay? And this is all profit. So once you get your fixed costs covered, you know, then all that contribution margin goes to the bottom line. Okay.